Let's take a look at life insurance. Now, life insurance is used to provide financial protection. So, a person buys life insurance so that if he or she dies, those dependents, children, spouse, etc., will have some financial protection. Now, there's several types of policies: term, whole life, universal, and actually variable universal. Now, let me talk a couple of minutes about that. Term life insurance provides only death protection. It's the least expensive type of coverage. So, in the case of a young person who's newly married, maybe has a baby, term may be a very good choice because if you're a non-smoker and you're in good health, you may be able to get a policy for very little money, but able to protect your family. The rates may be fixed for a certain number of years and then rise after that. Now, it's only death protection, so there's no savings feature, and the policy has to be renewed for coverage to continue. So at the end of the year, you have to renew the policy. Whole life is a contract, a life insurance contract with level premiums that has both an insurance and an investment component or a savings component. Insurance component pays stated amount upon death of the insured, so that's like term insurance, and the investment component accumulates a cash value that a policyholder can withdraw or borrow against. Universal life insurance is a type of flexible permanent life insurance offering the low-cost protection of term as well as a savings element like whole life insurance, which is invested to provide a cash value buildup. Okay. The death benefit, savings element, and premiums can be reviewed and altered as a policyholder's circumstances change. So, unlike whole life insurance, universal life insurance allows the policyholder to use the interest from his or her accumulated savings to help pay the premiums. Okay, the last one type of insurance, life insurance I want to talk about is variable universal life. And this is a form of cash value life insurance. Again, the policy builds up a cash value that the owner of the policy can borrow against. That also offers that death benefit. Obviously, the death benefit is critical because that's why you buy life insurance. But it also has this investment feature. The premium amount for universal life insurance is flexible, may be changed, so that's the universal part. Though these changes can result in a change in the coverage amount. So if you change, you can make changes, but you may have less coverage. So instead of having $500,000 in coverage, you might have $450,000 in coverage. The investment feature usually includes sub-accounts which function very similar to mutual funds and can provide exposure to stocks and bonds. The exposure offers the possibility of an increased rate of return over a normal universal life policy. So this is a case where you get to choose how you invest your money. Now, generally speaking, financial experts recommend that a person who needs life insurance to protect dependents should go out and buy a term policy and take the difference between what he or she would pay for the term policy and invest the rest. A lot of these life insurance policies have very, very high expenses, and so it would actually be cheaper to buy a term policy, and if you're saving $1,000 a year over a whole life for a universal policy, take that $1,000 and invest it in a good no-load mutual fund that has very low expenses. Okay, how do life insurance companies determine how much to charge somebody? Well, they use these actuarial tables to determine life expectancy. And you can see this table here says that this is as of 2007. A newborn male is expected to live about 75 years. A newborn female, so this is age 0, expected to live about 80 years, and then they have it for the general population. Now, as you move through time, if you've made it to 65 years of age, you have a pretty good chance of living another 17 years if you're a male, another almost 20 years if you're a female. And that's why females pay lower life insurance premiums, because they have longer life expectancy. And just to give you an idea of what a policy might cost, let's say a 40-year-old male non-smoker, and again, they try and break them up into different categories, male and non-smoker, in order to get the most accurate life expectancy. A $100,000 term policy might cost maybe $134 a year for a 40-year-old, but for a 60-year-old it would cost $810. And that makes a lot of sense, because the 40-year-old is probably going to live quite a bit longer than a 60-year-old. Not always the case, but statistically, again, life insurance is based on statistics and the law of large numbers. They know someone is going to die. They just don't know who. So they invest in, or they write policies for lots of people, and they know that they will have enough people who outlive the policy to pay for the people whose claims they have to pay. Now, life insurance companies get their funds from two sources. They get the premiums that must be used to pay out future claims when the insured dies, so when somebody buys a life insurance policy. They also receive premiums paid into pension funds managed by the life insurance company. So life insurance companies tend to manage a lot of pension assets. And I've got a couple of figures here just to show you how they've invested that money that they get. Now, in a previous video, I talked about some of the fundamentals of insurance, and one of the things that's unique about insurance is that you pay before you receive the benefits. Obviously, you can't wait until you die and have your spouse all of a sudden buy a policy on you. You have to have purchased that life insurance policy before then. So here's how the breakup is. This is as of 2008, 56% bonds, 24% stocks, and then about 11% loans and mortgages, and then 8.7% miscellaneous. And again, these are going to be longer term bonds, because a life insurance company is going to not just diversify by insuring a lot of people, they're also going to insure different age groups. They're not going to insure all 90-year-olds. They're going to insure 20, 30, 40-year-olds, as well as 50, 60, and 70-year-olds. And the next slide shows you how the percentage of life insurance company assets invested in mortgages. So you can see, if you go back to, this goes back to 1920, you can see that they held quite a bit in mortgages. It fell off a bit in the mid-40s, but then grew again through the 70s, through late 60s, but it's been falling pretty steadily since. And now life insurance companies hold what looks like less than 10%, between maybe 7 or 8% in mortgage assets. But prior to this, they held an awful lot in mortgage assets, and they've since diversified away to other types of investing.